800 million ounces that were accumulated by the Indians over the last several years. And I think it is absolutely non-coincidental. I think that the government has been behind this from the get-go. And I'd say the same thing about gold. The Exchange Stabilization Fund has been involved in this really since the very beginning, because it's not just silver, it's also gold. Since a year ago, November, when he won the election, it's every single month. And just the other day, we saw 2.94 million ounces of silver loaded out in a single day. GLD, which is a proxy for the price of gold, but to me it's functioning more as a deliverable reservoir. JP, Goldman, etc., they can source GLD shares and redeem what's called baskets, which are 100,000 shares. It's $4.2 billion worth of gold. Give it to me at subsidized prices.
Right,
it's
get the best deal they can.
Yes, and it's like jacking up the margin rates, which squeezed all the speculators. The price collapses. Saudi Arabia can indeed sell their oil to China for digital yuan, and right now is redeem those yuan immediately without going back into dollars. They're making it convertible without converting into dollars.
Could a potentially material part of the big withdrawals that were being taken, right, as some large players were standing for delivery from the COMEX, and you have surmised that these are probably sovereign entities, very well maybe the U.S. government. How much of that over the recent months could have been the government sort of stockpiling, knowing that it was likely going to go to war with Iran?
And if
it was part of it, is there a risk that demand going forward will be less because they were buying all this in advance?
Yeah, well, I don't think that that's a risk, because they've ignored this for years. We decimated our strategic stockpile, I don't know how many years ago. And so we're way behind the 8 ball there. You look at a country like India, who by all reports, and again, it's very difficult to piece this all together, but a lot of people think it's been well north of 800 million ounces that were accumulated by the Indians over the last several years. And I think it is absolutely non-coincidental. I think that the government has been behind this from the get-go. And I'd say the same thing about gold.
What looks like routine commodity movement may actually be quiet geopolitical positioning. As Andy Schectman points out here, the scale of withdrawals suggests sovereign-level demand, not retail or institutional noise. If India accumulated over 800 million ounces while the US depleted reserves, that signals a structural imbalance forming long before any Iran conflict narrative. Investors should question whether this is reactive buying or a delayed strategic scramble tied to long-term currency risk. Next, Andy Schectman discusses who might really be behind these massive deliveries.
I think someone got to the Trump administration, someone within the Trump administration got to the president and said, this is what's happening around the world with gold and silver. And if we don't understand this and beat them at their own game, or get into it very, very, very aggressively right now, this country will be forever compromised. And so, I think it is. If I had to guess, I would say the Exchange Stabilization Fund has been involved in this really since the very beginning, because it's not just silver, it's also gold. Since a year ago, November, when he won the election, it's every single month. And just the other day, we saw 2.94 million ounces of silver loaded out in a single day. This is not business as usual. This is the kind of withdrawal that tells you physical metal is being pulled with urgency. And I don't know who's doing it, but it's certainly big.
Okay, and those it sounds like those volumes of withdrawal have not been diminishing. So even here in the first half of March, we're still seeing, kind of this very high level of withdrawal.
Absolutely. 2.9 million ounces in one day.
A single day withdrawal of nearly 3 million ounces rarely happens without a deeper agenda. As Andy Schectman points out here, consistent monthly outflows since late 2024 suggest coordinated accumulation, possibly tied to policy awareness rather than market signals. If the Exchange Stabilization Fund is involved, that implies a defensive move against currency instability rather than opportunistic investing. For investors, this raises a key question. Are governments front-running a monetary shift while markets stay complacent? Next, Andy Schectman unravels why these withdrawals aren't slowing down.
Vault withdrawal is, I think it doesn't prove stress by itself, but it absolutely tells you it's more than just routine warehouse noise. This is way bigger than that. And yeah, I think we will continue to see that every single month. If past is prologue, we will continue. I just happen to think that this is a trend that will not stop.
Okay, but the demand for physical ounces, and we've seen it rise to unprecedented levels, that you haven't seen in your career. It's still remaining at those levels, even though the paper price has been softening a bit, right? So at some point, one of those two things needs to win out, right?
Well, and I think that the paper price is the greatest tool of misdirection, and I don't think people quite understand that. And what I mean by that, let me try and give you what I mean by that. And let's use gold as kind of the proxy for understanding that. Gold is like, for example, GLD, which is a proxy for the price of gold. But to me, it's functioning more as a deliverable reservoir.
When physical demand rises while prices soften, something in the pricing mechanism isn't reflecting reality. As Andy Schectman points out here, persistent vault withdrawals alongside weakening paper prices highlight a growing disconnect that markets rarely acknowledge. Historically, sustained demand eventually forces price realignment, yet here the divergence continues, suggesting deliberate suppression or structural inefficiency. For investors, this challenges the assumption that spot prices fully represent value in metals markets. Next, Andy Schectman shows how ETFs may be masking real physical demand.
And so what's interesting about it, the big interests in the US do not need to telegraph physical demand by bidding loudly in the open spot market, because that's what a lot of us can analyze. That's what we've been talking about. But what they can do, and these big money interests would be the APs, the authorized participants, JP, Goldman, et cetera. They can source GLD shares and redeem what's called baskets, which are 100,000 shares minimum, through their channels and receive London good delivery bars. So
you and I can't do this, but these very big players can, right? Yeah.
Right. And so what we saw recently was a very, very large redemption coming out of GLD. And it was like the largest redemption ever in its 20-year history. It was $4.2 billion worth of gold. It was a week or two in a single week, close to all-time high prices. But the largest weekly outflow in its 20-year history. Now, the media will frame that as this is, gold at the top, big money is repositioning, they don't trust gold anymore, but I look at it very differently.
The biggest gold outflow in GLD history happened right as prices hovered near highs, which defies typical selling behavior. As Andy Schectman points out here, authorized participants can quietly convert ETF shares into physical bars, bypassing visible market signals entirely. A $4.2 billion redemption suggests not liquidation, but repositioning into hard assets outside public view. For investors, this raises concerns about relying on ETF flows as a true demand indicator. Next, Andy Schectman discusses why these outflows may signal accumulation, not exit.
The combination of massive outflows while prices stay stable, and there's been a little bit of choppiness, but the prices have stayed relatively stable. This is exactly why I believe everyone has a right to be suspicious about this, because when price stays structurally strong, but ETFs are experiencing the largest, outflows ever in the history of the fund, to me, or to the media, the interpretation is no one wants gold anymore. But to me, somebody wants bars more than they want the ETF exposure. And this is, to me, what is exactly happening, not just on COMEX, but they're doing the same thing in GLD and SLV, where they can create or redeem baskets, massive amounts, with a lot of, let's just say, a lack of transparency. And so what you see is the biggest money in the world pulling every single string they can to take physical possession. And you're seeing these outflows not just in GLD, but in SLV too. And it's not as easily transparent like you would be if it were coming off the COMEX, which would, a lot of it would show up in the commitment of traders report and the outflow reports.
Okay.
Stable prices during record ETF outflows is exactly where the market narrative starts to break down. As Andy Schectman points out here, when the largest outflows in history don't move price lower, it signals a shift from paper exposure to physical ownership behind the scenes. The media frames this as declining demand, yet structurally stable pricing suggests strong underlying bids absorbing supply. For investors, this raises a key concern. Are price signals being distorted while real accumulation accelerates quietly? Next, Andy Schectman unravels whether market weakness is masking forced selling.
I'm just pulling from some questions here going through in the live chat. In addition to that, how much of the weakness, if any, recently in the precious metals, Andy, do you think is due to the fact that the stock market has been weak and that people may be getting margin calls, in some of their positions, and when you get margin called, you just have to sell what has value? And so, we typically will see this if the markets really go into a sizable correction pretty quickly, which we haven't seen that level yet, but when that has happened historically, we usually see the precious metals go down initially with the markets because they're getting scolded, and then they obviously recover usually before the markets do. Is that playing a factor here at all?
That's what we've always been told. And again, I go back to what Jim Sinclair and I talked about. That's mope, in my opinion.
The idea that metals drop because of margin calls sounds logical, but history doesn't fully support it. As Andy Schectman points out here, this narrative assumes investors holding leverage also hold significant physical metals, which is rarely the case in real portfolios. During past corrections like March 2020, gold dipped briefly but rebounded faster than equities, suggesting liquidity stress is temporary, not structural. For long-term investors, this challenges the assumption that weakness equals risk rather than opportunity. Next, Andy Schectman discusses whether this explanation is just a convenient excuse.
The conventional wisdom is throwing out the baby with the bathwater. And yes, you get liquidity. I have always felt that was just an excuse. Look, if it's a pretty much agreed upon assessment that the metals markets have been heavily managed, right? Call it what you want, manipulation or management, it's the same thing. Then the time to manage it is exactly when everyone is freaking out, because the last thing that they want to see is a dumping of dollars and an escalation of gold and silver, because it shines a light on the fragility of the entire system. And so, yes, we can call it throwing out the baby with the bathwater, getting liquidity. It's the most liquid. You can cover your margins. I don't believe that, because most of the people on margin, they don't have an ounce of gold to their name. To me, this is just managing the situation. So when you see the price dropping and the deliveries accelerating, it's almost as like, oh, are they just knocking down the paper price to quell that anxiety at the same time?
Price drops during panic often reveal more about control than true supply and demand. As Andy Schectman points out here, if markets are managed, then volatility events become opportunities to suppress signals that expose systemic weakness. Historically, sharp gold rallies during crises highlight currency fragility, something policymakers aim to avoid, especially during periods like the 2008 crisis or 2020 liquidity shock. For investors, this reframes sudden declines not as natural selling, but as potential intervention moments. Next, Andy Schectman unravels how pricing pressure aligns with rising physical demand.
Give it to me at subsidized prices.
Right, get the best deal they can.
Yes, and it's like jacking up the margin rates, which squeezed all the speculators. The price collapses, and then you see huge deliveries, like the December delivery, which was the biggest December delivery in the history of the COMEX market for the month of December. You're seeing price really, I think, being misdirection from global demand and from the understanding that gold and silver would be the place to be. And if they're going to knock it down for you, great. We'll stand for delivery at a better price. To me, it's the opposite of what they want you to think. But what you said is conventional wisdom.
Okay. All right. I am going to, the other big topic I want to get to in just a moment is the CME margins. So we'll get to that in just a sec. I just want to pull up this comment here because True Texan was kind enough to pay to submit the comment. He says, he asks, tell me one government you would trust to hold your gold.
When the biggest delivery month follows a price drop, the signal flips from weakness to strategic accumulation. As Andy Schectman points out here, margin hikes often flush out leveraged traders, creating artificial price declines that benefit large buyers stepping in for physical delivery. December's record COMEX delivery volume suggests that lower prices triggered demand rather than reduced it. For investors, this highlights how volatility can be engineered to transfer assets from weak hands to strong ones. Next, Andy Schectman discusses the deeper implications behind rising CME margin pressures.
So, Andy, if you had to put your faith in a government to not raid the vault that your gold was stored in, is there a government that tops the list? I mean, I'm going to guess maybe the U.S. because you've got your money in spring spots here. But yeah.
Yes, I mean, look, there still is the rule of law, but it depends how big of a, what are we talking? Are we talking physical gold held at Brinks? Sure. The U.S., I don't think will activate eminent domain. I think it would be far easier for them to go in and take SLV and GLD, which are controlled by JP Morgan and BlackRock, who JP paid the $920 million fine, the largest the Justice Department had ever issued at that point, for manipulating the metals market. It would be much easier for them to do that. I guess if I had to think of one country, and even they disappointed many years ago by closing out things with Viamet and all the Swiss banks, would be Switzerland.
Trust in governments sounds stable until you examine how easily financial assets can be accessed versus physical ones. As Andy Schectman points out here, ETFs like GLD and SLV sit within institutional control, making them far more vulnerable to intervention than privately held bullion. The $920 million fine against JP Morgan highlights that even regulated markets have deep structural risks investors often ignore. For portfolio protection, the distinction between paper and physical ownership becomes critical in extreme scenarios. Next, Andy Schectman discusses why even trusted jurisdictions may not be reliable.
They have a history of that, but the real issue is that I don't think any government these days is really trustworthy. This is why you get the old adage, if you don't hold it, you don't own it. But from a standpoint of building an ecosystem, if any of these countries are going to attempt to integrate gold into the monetary system, you get one chance, because the minute you deviate from transparency and trust, you're done. Mm-hmm. And I think that is, that's kind of the reasoning behind what China is trying to do by multi-jurisdictional vaulting in all throughout the Belt Road, which is not just China, it's Asia, it's Africa, it's South America, so that you have all of these vaults in the countries of all of the participants. So the next vault is being built in Saudi Arabia, and as is right now, Saudi Arabia can indeed sell their oil to China for digital yuan, and right now, which it's completed, is redeem those yuan immediately without going back into dollars. They're making it convertible without converting into dollars. Mm-hmm. In the Hong Kong branch of this new Shanghai Metals Exchange, the next one will be in their own backyard in Saudi Arabia. So who do you trust? I don't know. When all the chips are down, yes, I want to trust the U.S. I think Switzerland is a good choice, but I think that is why you're seeing, they see the same thing. That's why you're doing multi-jurisdictional vaults, and that's why the mBridge, their cross-border payment system, central bank cross-border payment system for the banks, the vaults are held in the jurisdiction of the countries that are involved. So if India were to have a node in this deal, they would have their own vault with their own gold inside the vault, and the idea is to sprinkle their gold around all of the vaults so that everyone has, their gold dispersed amongst the trading platform, if you will. It's a fair question, an answer that's impossible to get to, because desperate governments do desperate things. So how desperate can this get? I guess only time will tell. But I think that is the riddle they're all trying to solve, and certainly a good way to do so is by branching out your vaults into the participating network of countries that are involved in this new system.
The shift toward multi-country gold vaulting isn't about innovation. It's about declining trust in centralized systems. As Andy Schectman points out here, distributing gold across jurisdictions like China's Belt and Road Network signals preparation for a fragmented monetary future. The ability to trade oil in yuan and redeem it without touching dollars challenges decades of dollar dominance, especially post-2022 sanctions trends. For investors, this raises a deeper issue. Global financial plumbing is being quietly rewired. Next, Andy Schectman unravels how individuals should think about holding wealth in this environment.
Wells Fargo or Citibank or whatever, right? So if they do knock it down, the overall market value of my holdings go down in the near term, but as an accumulator, I say, hey, that's great, because I've got confidence that it's going to be higher at some point in the future. And right now I can buy in at lower prices in my regular purchasing. I'm presuming you think that's probably a pretty good way to think about it, but
1,000%. I mean, and that's 1,000%. Saving in dollars is disastrous. It has the lasting value capacity of a melting ice cube. And I often use this example, but you can choose any asset. And I've said this on your show before, but for people who didn't hear it, look, the wisdom of holding your wealth in your excess cash in gold, to me, is extraordinary. But let me just show you quickly. 2005, I can pick any number, but 2000, I've said this so many times on podcasts, I remember it.
Buying into weakness only works if the underlying asset truly preserves value over time. As Andy Schectman points out here, the melting ice cube analogy for fiat currency reflects long-term inflation erosion, not short-term volatility. Since 2005, the dollar has lost significant purchasing power, even as asset prices rose, masking real declines in value. For investors, this reframes dips in gold not as losses, but as potential accumulation points within a broader currency debasement cycle. Next, Andy Schectman shows how this plays out in real purchasing power terms.
2005, the average price of a house in the country was $240,000. Gold was $455 average price in 2005. That's 510 ounces or thereabouts. You could have used that 510 ounces to pay off the house. You don't. You put it under your mattress, earning nothing but dust. And that's what, the financial, it doesn't pay any yield. Why would you own it? Okay, fair enough. The house has doubled. Today it's 500,000. Great investment. You did well, right? But those 510 ounces today times roughly $5,200 or whatever, you're talking $2.6, $2.7 million, which buys you 5 fully furnished houses. So your house doubled in dollar terms, it lost 500% or more in gold terms. In other words, the dollar is falling faster than assets are appreciating. Gold is what exposes that. So yes, I think the most important thing to do, whatever you do, is realize that the very, very wealthy people, they hold their wealth in assets. Assets will feed you. Liabilities, which is what a dollar is, will eat you. And if you hold your wealth in dollars, you don't see your dollar value going down, but what you will see is that the purchasing power is getting crushed. And that's the thing that's harder to see unless you look at any asset in ounces of gold. In other words, easier said, in dollar terms, assets have been going up. In gold terms, those same assets have been going down because gold is holding its value better than the dollar we measured values in is evaporating. That's the important lesson. So yes, That's how I hold my gold too.
A house doubling in price sounds like success until you measure it against a stable unit of value. As Andy Schectman points out here, the shift from 510 ounces buying one home in 2005 to potentially 5 homes today reveals how currency depreciation distorts perceived gains. Nominal returns look strong, but real purchasing power tells a very different story, especially in an inflation-driven cycle. For investors, this underscores the importance of measuring wealth beyond dollars.